We are seeing a bit of a relief rally in this market right now, and my portfolio jumping over 2%, trading back up to over $34,000 in the gains for the day, as Bitcoin rebounds back over 70,000 after nearly breaking below 60K just 1 day ago. And of course, we did a poll asking everyone, can Bitcoin actually go down further? Of which 64%, almost 70% of people once again said that it has not yet bottomed. It has more downside left. So even analysts say that Bitcoin could signal further downside. So we'll find out, of course, with time if there is more downside to come. Dow surging over 1,200 points. In fact, closing for the first time ever over 50,000 points in a sharp rebound from a tech, as it is pushing higher on Nvidia. Shares jumping over 8%, as Jensen Huang says the $660 billion capex buildout is indeed sustainable, as tech AI spending may approach $700 billion this year in 2026. But the blow to cash raises some red flags. But Jensen Huang essentially mentioned that the capital expenditures from AI companies is justified, appropriate, and sustainable. And the reason for that is because all these companies' cash flows are going to start rising. And Huang said the largest infrastructure build out in human history is being driven by sky-high demand for computing power, which AI companies and hyperscalers can use to make more money. He cited specific examples of what Nvidia customers are doing with artificial intelligence and with AI. So Hims and Hers plummeting further, down over 16% over Novo Nordisk's lawsuit. And I think FDA also mentioned that they will take action against Hims and Hers. And as a result, it was dropping further. I mentioned this in the live stream very, very briefly, but I mentioned this clearly, that it's really important to not jump the gun. And given that, Hims and Hers is in the middle of a very big battle with Novo Nordisk, it's really important to take it step by step and really try to evaluate the situation. Because on one hand, you got Novo Nordisk, which is a $300 billion business, going after Hims and Hers, which is a $4 billion business, $5 billion business. And I think it's really important for us to let the dust settle, understand, see what comes out of this, and then decide whether Hims and Hers still has potential or not. For me right now, it's part of the options portfolio, just about 100 shares, very, very small position. But yes, it is absolutely getting destroyed, trading down in the teens, literally from 70 down to now in the teens, as it continues to get ripped apart by Novo Nordisk here. Now, S&P 500 pushing up almost 2%. You got the QQQs up over 2% as well. So very strong momentum coming in. Is this a dead cat bounce? Is this a technical rebound? We will talk all about it. But so this right here is what the heat map looks like. And despite the market sitting at all-time highs, we do still have a lot of companies sitting down in a pullback or a correction. You can see Apple's down over 3.6. Google's down 7.5%. We got Nvidia down over 12.6, although pushing higher a little bit today, pushing up almost 8%. We got Meta Platforms down over 17%. Tesla's down almost 18%. Amazon's down almost 19%. Broadcom's down almost 20%. I've been picking up Broadcom. I've been picking up Palantir as well. AMD's down almost 22%. I've got a video coming out on AMD later today. We got Microsoft down over 27%. Netflix is down over 38%. So there is still a lot of pain and a lot of losses for a lot of these companies. But then again, if you look at these indices, you've got them sitting at all-time highs. So you've got the Dow Jones Industrial Average sitting at just under 50,000 at all-time highs. We got S&P 500 Energy, Consumer Staples, and the index itself is less than 1% away from all-time highs. But all of these are sitting at all-time highs, as the market did indeed, broaden out to other sectors and other parts of the market as well. So over $1.1 trillion worth of gains, a lot of liquidity flooding back into the S&P 500, as the MoneyVest index is sitting at 3.69 again. So we're seeing a nice little lift from neutral, getting back up to optimism at 3.69, and the Nasdaq 100 also from uncertainty is back over to neutral at over 3.19. And in terms of earnings, next week is also going to be very important, packed with some very important companies. We got Gilead Sciences, we got McDonald's, we got Cisco, we got Arista Networks, Applied Materials, T-Mobile, we got Coca-Cola, AppLovin, Unilever, Vertex Pharmaceutical, part of our shopping list. So that is going to be coming out with their earnings. We got Robinhood also scheduled for Tuesday. We got Shopify, we got Airbnb, BP, CVS. The list goes on and on, because we do still are in the middle of the earnings season, and still a lot of companies are yet to go with earnings. Now, when it comes to economic calendar, we did not get to the unemployment report. It is going to be coming out next week now, so it's going to get updated. And we also do have inflation numbers. We have inflation and the labor market report both packed in the same week, along with earnings, as well as what is going to be the fate of this market, given so much volatility and so much uncertainty around individual stocks and technology and growth. So volatility here dropping a little bit over 18.4%, trading back down to under 18, and crude oil prices stable at over $63 a barrel, with Bitcoin back over $70,000, and Ethereum also pushing back up, sitting just under $2,100. We're getting a little bit of relief in this market right now. So coming over to the S&P 500, so very, very strong green day, with a lot of buyers stepping in at that support, as we discussed, at 67.85 or close to 6,800. So very nice momentum back up and a resistance all the way up to as much as 7,000 points on the S&P 500. For the NASDAQ, same thing. I think what is really interesting is that this is still within the context of a downtrend. So I would argue that this is a bit of a lower low for the NASDAQ and a bit of a lower high also forming for the NASDAQ. So are we out of the woods? Are we in the clear? Nobody knows, right? Nobody can really predict. But I think it's really important to stay on your toes. And of course, keep in mind, if you do get a breakout above this downtrending channel, that would be a clear signal that we're out of this downtrend. But if you get rejected, if you get a little bit of a breakout above this 23,100 and get up to this resistance of lower high and get rejected again, and then potentially sell off further to this lower low. So in other words, if you do something like this, where we push up and then come back down, test this lower low, then that would signal that we're not out of the woods yet. And I mean, we are still looking for some more potential downside, and the NASDAQ could get into a correction. So that's really where we are with volatility coming back down. Market's getting a nice little technical rebound. This is nothing but an oversold technical dead cat relief rally. Is this going to mount into something bigger? Are we going to recover back higher? Of course, time will tell, but this is the overall downtrending channel within which we're still trading. Coming over to Apple, and Apple here also getting a bit of a breakout. Support level is going to stay put roughly around 277. So that is going to be that support level to watch, all the way down to 265 for Apple. That's another thing to watch. And this was, again, the lower high and the lower low pattern. We sold off and we rallied right back up on the back of that India and US deal. 14% higher. Next resistance back at all-time highs at 288, 289 for Apple. Amazon also with a huge gap down on earnings, although buyers stepping in intraday, but still down over 5% on the day. This is going to be a resistance where it got perfectly tagged at 210, at 211, and then getting rejected at those levels here. But again, a lot of buyers stepping in here at this support, roughly around the 197, close to $200 level. So it didn't quite breach the 200 level, but it did bounce right off that level and pushing right back up to 210, 211 for Amazon. Coming over to Tesla, and Tesla also getting a nice bounce back higher, resistance all the way up to 413, 414 with a support level that's going to stay put at 383, 384 for Tesla. And if you do get a breakout above this, next target, next resistance all the way up to 454 for Tesla moving forward. Coming over to Nvidia pushing up over almost 8% on the day, so very nice to see that. This is a breakout above this resistance, and this is going to turn into a support now for Nvidia, so roughly at 183, 184 with a resistance all the way up to as much as 193, 194 for Nvidia moving forward, with a support level that's going to stay put at 169, 170 for Nvidia in the future. But right now we're seeing a lot of consolidation sideways, and it's been in that range bound pattern for a really long time. Talking about advanced micro devices, support level is going to stay put at 194, 195 with a resistance all the way up to as much as 224, 225 for AMD. So that is going to be that next target. That
things can't just keep going up. That's just not the way this works. We have these things called market cycles, and they're actually very predictable. Through my MBA studies and PhD studies, I had to deep dive through this subject, but one of the best books on the subject that you could read is called Mastering the Market Cycle by Howard Marks. It's a guide to understanding recurring market patterns. Success comes from recognizing where we are in a cycle and adjusting investment strategy accordingly. You gotta balance aggression and defense based on psychology and economic conditions. Do yourself a favor and read this book. I don't make a commission or anything like that on this. I just like to give credit where credit's due, and this book right here is gonna help you so much. If you plan to be a serious investor for a long period of time, you gotta read this book. Okay, so I'm gonna give you the biggest news in the past week or two as to why the market's been dropping so much, because it's very important that you understand that. But first, I wanna give you the answer to the test. I wanna give you what to invest in right now and what I've been investing in heavy since last year, and I'm continuing to invest in heavy today. Obviously, we've been in a very tech-heavy, very AI-hyped market over the last couple of years. And the opposite of that would be the value market. This would be the boring, recession-proof style company. Things that do well even in bad economic times. To keep your portfolio safe, especially in the event of what we're seeing right now, this is the type of balance that you need. The easy, simple way to do that would be to add SCHD and or VTV to the portfolio. But the best way would also be to understand these dividend-giving assets and the power that they have in your portfolio, not just during bad times, but really forever. Right now, though, this is the perfect time to start getting into these. I believe 6 months from now, all of these types of assets are going to be the things that are outperforming, and so right now is the time to get in. When that new Fed chair takes office and they start cutting rates like crazy, dividend-style assets are going to go through the roof, and I don't want to have to come on here and say I told you so. Let's just get in right now. So there's 5 big reasons right now, and the first one is obviously that technology or AI sell-off. A major theme this week has been a sharp decline in tech stocks, especially in the software and AI related sectors. The S&P 500 Software and Services Index has lost roughly $1 trillion in market value since late January as investors reassess pricey tech valuations and future growth expectations. Number 2 kind of goes along with number 1, but one of the big reasons why everything is crashing so hard is not necessarily because these stocks or ETFs are bad or that they don't hold value. It's just that there's some humongous, huge AI spending concerns. Several mega cap tech firms like Amazon, Microsoft, Google, and Meta announced hundreds of billions of dollars in AI capital expenditures for 2026. This has spooked investors who fear this spending may not produce returns quickly enough. For example, Amazon stock dropped about 9% after unveiling a $200 billion AI investment plan, weighing heavily on overall market sentiment. Now, to me, as an entrepreneur and as a university professor that teaches on entrepreneurship and business and finance, to me, these types of things look very, very good and appealing, and these are a reason why I would want to invest in a company like Amazon. If they're spending that much on infrastructure and research and development and just improvements in general, especially a mature company like Amazon who's been known to spend a lot of money to enhance their company, and then down the road, maybe 3 years, 5 years down the road, it works out very well for them and for investors. This is just a pattern. And so I actually like the price of Amazon right now. I actually told my Patreon group that this now looks like what Google looked like last year when I was telling everybody Google's so undervalued right now, and then it shot up. That's what I think Amazon is, and I kind of like these prices right now, especially anywhere in the $200 range. Number 3, why we've seen such a big crash lately is economic and job weaknesses. Reports showed larger than expected job cuts and signs of a weakening labor market, which intensifies fears that economic growth might be slowing more than expected. Rising unemployment claims and poor job openings also pressured investor confidence and accelerated risk-off trading, which leads us to number 4, which is just risk assets, specifically crypto, is just declining like crazy. Obviously, Bitcoin plunged like crazy over the last week and really over the last couple of days big time, which led to so much emotional selling and just played into this whole idea that people are taking money out of these riskier assets and they're starting to move it over to value and dividends. It's very, very clear to see. You can see that anything that's heavy red is risky or growth. Anything that's starting to be green is value, dividend style, cash flow style. That's where it's going. It hasn't totally moved over yet, so you still have time, but that's where it's going. And number 5 is earnings and macro headlines. Ongoing earnings season has brought mixed results, and markets often react more strongly during earnings when valuations are high. Investors again are de-risking after extended tech gains rather than a structural crash. So that's what I'm saying. Everything's moving towards that value. This is why SCHD is one of the only green ETFs this year, and up over 13% where almost everything else is down. So I know I'm beating a dead horse here, but this is the time to start really focusing on and learning about these dividend or safer style assets, because not only is it going to keep the portfolio safer and more stable, I believe it's actually going to have more growth in appreciation and obviously in cash flow by the end of 2026, and so right now is the time to get in. And so now, yes, we are seeing a big decline, but are we really in a crash yet? Not exactly, in the classic sense of like the 1929 or 2008 crash, but this is a significant drawdown and it has a lot of volatility, especially in tech and speculative assets. Like I said before, major indexes like the S&P 500 and the NASDAQ 100 are down multiple days in a row. The selling is broad-based across tech, crypto, and some commodities. But traditional safe havens and defensive stocks aren't signaling panic in the same way as in a full meltdown. This is very important for you to understand. In an actual huge market crash, everything is going to dip. Obviously, growth, tech, AI, those are going to dip further because those are more volatile than just the regular S&P 500. But in a real crash, even things like SCHD or VTV in these defensive style sectors would drop a little bit as well. What we're seeing right now is a rotation. We're seeing the high risk assets get pulled back, and many are taking that away and putting it into things that they see as value. So this isn't a total crash yet, and we'll see if that actually happens or not. This is a rotation, and this is why I'm pleading with you to start really thinking about getting that side, the value side, more built up in your portfolio. That doesn't mean the crash can't happen or won't happen. It's just not necessarily what we're seeing right now.